Welcome to the Thematics at Goldman Sachs. My name's Tom Lydon with ETF Trends, and in this series, we'll dive into the recently launched actively managed thematic funds and what you'll need to know about how this works in your portfolio. To start, we're kicking off with Katie Koch, co-head of fundamental equity at Goldman Sachs Asset Management, to talk more about this launch and what it means for advisors. Thanks for being with us, Katie.
I'm really happy to be here, Tom. Thanks for having us.
So, Katie, over the last decade, we've seen a shift of assets from active into passive, with a full 50% of all equity assets in the U.S. now in passive investments. Why do you think savers need to think differently about their asset allocation going forward in order to generate the returns they desire?
Yeah, there's three main reasons that we think savers are going to have to think differently about their portfolios going forward. The first and perhaps most critical is that we are strong believers that the traditional 60-40 portfolio is broken. That's obviously 60% stocks, 40% bonds. That's been a very standard asset allocation and one that's reflected in a lot of people's accounts. But that set it and forget it approach, which frankly did work very well over the last 10 years because the U.S. equity market, even market cap weighted passive U.S. equity market, was such a strong performer. But over the next 10 years, we expect returns to be much more muted. So specifically, we think that portfolio, which delivered 10% compounding returns over the last decade, is actually likely to deliver only 3 to 4% over the next decade. And so people are going to have to do things differently to get strong returns going forward. The second and linked to that is that we believe that those market cap weighted benchmarks are quite backward looking. And if people have a lot of indexation of equity in their portfolio, that's not going to serve them well over the next 10 years. The challenges with those market cap benchmarks are really twofold. The first is that they're hyper concentrated. So 21% of the S&P 500 is now, of course, in 1% of the stocks, just the FANGs. To put that into perspective, just those FANG stocks have a market capitalization now that is greater than all of global emerging markets equity. And so people are too concentrated generally in a couple of names. And history has shown that in over 10-year periods, the leadership of stocks change. And so you want to be in something that's anticipating the future and anticipating the future winners in our view.
Well, you're dead right. We're experiencing a ton of disruption across all industries. So going forward, what are the key secular growth trends that you're most excited about?
The first one would be around technology and the innovation happening in the tech space. And we are just big believers that the future winners in tech are going to look really different than the platforms that we all know really well today. And so we believe in the merits of investing in tech companies below $100 billion in market cap. And those companies exist all over the world and really down to 100 million in market cap. The most powerful consumer now in the world, of course, is the millennial consumer born between 1980 and 2000. I was born in 1980, so that makes me a geriatric millennial, one of the oldest ones out there. But it is a very large generation. These individuals are actually hitting their peak spending years. And an important fact to know about them is 85% of them actually live in emerging markets. And they do have, people mistake millennials, and many of them remember them as the younger kids that lived in their parents' basement for a long period of time, but now they're in their prime earnings years. We think that their spending is going to increase by 10 to 15% over the next decade, while baby boomers is actually set to shrink. So it's really important to understand the tastes and preferences of the millennial consumer. Very big picture in this country, we spend 25% of GDP for the worst healthcare outcomes in the OECD. What happened to retail? We talked about Amazon disrupting retail. We're right on the precipice of that happening to healthcare, meaning that technology is going to come into healthcare. Cost curves are inflecting down in places like genomics, and we're going to get a much better deliverable, a better healthcare outcome at a much lower cost. And we want to invest in the solutions providers of that transition to a cheaper and better healthcare for Americans and frankly for people all over the world. So we believe that we are on the cusp of a sustainable revolution, which will have the speed of the digital revolution and the scale of the industrial revolution. And this is just the idea that if we as a global community want to achieve the Paris Agreement, which is to keep global global warming at a maximum of 1.5 degrees, we're going to have to attack this holistically. So renewables is part of this, and we are invested in companies that are renewable energy and renewable fuel companies, but it's much more holistic than that. So you want to think about recycling of plastic, recycling of clothing. We're actually invested in all of these concepts. You want to think about alternatives for single-use plastic.
Those are great trends, great opportunities. Geriatric millennial. I love that, Katie. But I'd rather be a geriatric millennial than myself. I'm a baby boomer. Hey, look, how do advisors get a hold of these types of trends, especially with what you folks are offering? Can you talk about that a little bit?
Sure, absolutely. So similar to how we approach investing in our portfolio companies, we understand the need to disrupt ourselves in a highly competitive and fast-moving asset management industry. And so we've been creating differentiated, dynamic solutions to help our clients position themselves on the right side of disruption. We launched our first thematic strategy 6 years ago. We now manage over $21 billion in a lot of the themes that I just spoke about. The success of these thematic products has really helped double our assets in less than 18 months. And also, most importantly, has put us in a position to deliver some great returns for clients. We continue to experience success and client demand for these thematic products. We've had $3 billion of additional flows year to date. And we've recently launched a suite of 5 thematic ETFs for our U.S. investors that are aligned to the megatrends I just talked about. Those ETFs would include GTEC, GTEK, which invests in technology companies with market capitalizations less than 100 billion, seeking to give investors exposure to next generation tech leaders. GBUY, GBUY, which invests in companies aligned with millennials and increasingly also Gen Z and their consumers' differentiated spending preferences that we walked through. The third one would be GDOC, GDOC, which invests at the intersection of healthcare and technology. Fourth would be GS Future Planet, which is GSFP, which invests in clean energy, resource efficiency, sustainable consumption, and the circular economy, water sustainability, everything that's involved in transitioning us to that more sustainable planet that we want our children to inherit. And then finally, GREI, which is real estate focused. It's a lower beta, high yielding way of providing investors exposures to these secular growth themes, because they're invested in the real estate and infrastructure assets that house many of these secular growth ideas. So think about the proliferation of data and having exposure to data centers, or the energy transition, which is requiring a need for clean energy infrastructure. Those are the types of assets that we would invest in GREI. So the real estate and infrastructure beneficiaries of a lot of the themes that we just talked about.
Katie, thanks for joining us. This was fantastic. Look forward to learning more about thematics on Goldman Sachs, and we'll see you next time, okay?
Thank you so much for having me.